The next adjusting journal entry of prepayments is deferred revenues. This prepayment represents a prepayment from the customer. When the company receives cash payments in advance, the company will debit cash, but the company does not recognize revenue because goods and service will be provided later. That's why we called it a prepayment from the customer. Instead of recognizing revenue, we credit unearned revenue. Unearned revenue is not a revenue, it is a liability. Later, when the company provides goods or service, depends on the amount or the value of the goods and service, we will make adjustment to recognize the revenue. So this journal entry is not adjustment. The adjustment I'm going to introduce is the realization of the unearned revenue, or the unearned revenue is earned. We have one example from the external transaction in the prior slide regarding unearned rent revenue. Remember this transaction on July 16th. The jewelry store prepaid $1,000 for 2 months' rent. Here, the company recognized cash as an asset, 1,000, but it recognized a liability, unearned rent revenue here. By the end of this accounting cycle on July 31st, because from July 16, when the prepayment was received, it has been half month. Half month's rent is $250 because 1,000 is for 2 months. So every month the rent is $500. Half month, so is half of $500, $250. So here we should make adjustment to recognize the rent revenue for $250. So deferred revenue adjusting journal entry, we are going to debit the liability deferred revenue and recognize the rent revenue, $250. You will also see originally the balance of deferred rent revenue was $1,000. After this journal entry, the balance reduced to $750, which represents 1.5 months prepaid rent. We will make another adjustment next month. Okay, but on July 31st, we only recognize half month rent because it is from July 16th to July 30th. By making these adjustments, the company recognizes revenue while reduce the liabilities. So the impact on the accounting equation is we debit liability, the liability reduce, while we credit revenue, stockholders' equity increase. This adjustment recognizes revenue, so revenue increase, so the profits will also increase. On the balance sheet, because we debit liability, liability reduce. We credit revenue, retained earnings, or stockholders' equity increase. So accounting equation, unearned revenue as liability reduced by $250, while stockholders' equity increased $250. The accounting equation is still balanced. If we don't make such journal entries, the liability will be overstated because we didn't reduce the liability, while the stockholders' equity or revenue will be understated. This company does earn $250 rent revenue by the end of this month, right? So we should make this adjustment. Yeah, so this is an internal transaction. It is not as evident as external transactions. So we should calculate the amount and make the adjustment accordingly. This is a practice to check the balance of deferred revenue in 2025. We can use the T accounts of deferred revenue. In 2024, the balance liability was $17,200. $68,000 was received from customer for the subscriptions. So this is considered a prepayment from the customer. So deferred revenue increase by $60,000. And because the company recognized $69,700 revenue, according to this journal entry, we should also debit deferred revenue by this amount. So debit, we should put 69,700 on left. That's debit. So we compare the both sides. Finally, we get a credit balance 15,500. So that's the balance of this unearned revenue liability in 2025. The 15,500 is the ending balance in 2025. Here, this is a beginning balance from prior accounting periods. That's a prepayments. This is the result from prepayments. We debit cash and credit deferred revenue. This is from the adjustments. Finally, we have the ending balance.